All right, let's talk about a company that's probably in your liquor cabinet right now, Diageo. We're talking about a true giant in the beverage world. But what's really interesting is that its stock has, well, it's taken an absolute beating lately. So we're going to dig in and see what's going on.
And that really gets us to the heart of the matter, doesn't it? Is this massive price drop a huge red flag telling us to run for the hills? Or could this be one of those rare, maybe even once-in-a-decade chances to snap up a fantastic company at a deep, deep discount?
I mean, just look at this chart to see what we're talking about. It's pretty stark. Not too long ago, Diageo's stock was riding high at around 26 pounds a share. Today, it's hovering closer to 16. That is a serious haircut, and you can bet that's what's got value investors' ears perked up.
To put a single hard number on it, we're talking about a fall of roughly 40% from its recent peak. Now, for a blue-chip, globally dominant company like this one, a drop that big is, well, it's pretty unusual, and it definitely makes you want to take a much closer look.
But before we get totally lost in all the numbers, let's just take a step back. Who exactly is Diageo? Well, simply put, they are the absolute powerhouse behind some of the most iconic and beloved booze brands on the entire planet. I mean, come on, look at this lineup. Johnny Walker, Guinness, Smirnoff, Don Julio, Captain Morgan. These aren't just drinks you see on a shelf, they are cultural institutions. This portfolio is just incredible, and it gives Diageo what investors love to call a moat, a massive competitive advantage that's almost impossible for anyone else to replicate. Okay, so keeping that incredible brand power in mind, let's get to the fun part, the core investment thesis from our source material. Why on earth are some analysts looking at that 40% price crash and seeing a total bargain?
So the whole argument for buying right now really boils down to these four key ideas. First, that massive discount we keep talking about means a ton of the bad news is probably already baked into the price. Second, even with the slowdown, this company is still a cash machine. Third, you've got those irreplaceable brands we just saw, that's your foundation. And finally, you put it all together and what do you get? A risk-to-reward setup that looks pretty darn attractive.
All right, let's get into the nitty-gritty. This whole bargain idea isn't just a gut feeling, you know. It's backed up by some key financial metrics that are practically screaming that this stock is cheap, especially when you compare it to its own history. This table right here tells so much of the story. Let's start with the forward PE ratio. It's basically a quick way to see how cheap a stock is compared to its future earnings. Right now, it's at 11.6. Historically, it's been almost double that, somewhere between 20 and 25. Then you have the PEG ratio, which factors in growth. Anything under 1 is often considered a sign of being undervalued. Well, Diageo's is 0.65. You put these numbers together and they suggest that the market's expectations have hit rock bottom.
And as if the low price wasn't enough, you get this, a dividend yield of about 4.7%. Think about that. That is a really solid return. You're getting paid in cash just for owning the stock while you wait for things to potentially turn around. For anyone looking for income, that is a huge, huge plus.
You know, all of this, the low valuation, the high dividend, it's all about creating what the legendary value investors call a margin of safety. The idea is simple. You buy a fantastic asset for way less than it's actually worth. That way, you have a built-in cushion in case things go wrong. It is the absolute cornerstone of this whole investment thesis. Of course, let's be real. A stock like this doesn't get so cheap without a good reason. So to be fair and balanced, we have to look at the very legitimate risks that have sent investors running and pushed this price down so far. And look, these headwinds are no joke. The company's carrying a pretty hefty debt load. Consumer tastes are changing, with a bigger focus on health, and younger generations like Gen Z are just drinking less alcohol in general. Add to that a global alcohol market that's pretty much flat and fierce competition from non-alcoholic drinks, and, well, you can see why a quick comeback is far from a sure thing. So, given all that, the big question is, what could the future actually hold? The analysis in our sources breaks it down into 3 possible scenarios for Diageo over the next 5 years, which is a great way to help us weigh the risks against the potential rewards.
And what I love about this is how it illustrates the whole range of possibilities. In a pessimistic world where things stay pretty tough, the analysis still points to a positive 25% total return over 5 years. Not bad for a worst case. The base case, just a simple return to business as usual, suggests a 61% return. But if things really turn around and sentiment improves, well, an optimistic scenario could deliver a 119% return. We're talking more than doubling your money.
Now this, right here, is probably the single most important takeaway from all that scenario planning. Even if the bears are right and the business kind of stagnates, this analysis suggests it's actually hard to lose money over the long haul if you buy in at today's price. That speaks volumes about that margin of safety we were just talking about.
Okay, so let's try to bring this all home. How do we balance these very real challenges against these pretty compelling numbers? And really, who is an investment like this actually for? It all comes down to this classic tug of war, doesn't it? In one corner, you've got the very real risks, the high debt, the consumer slowdown. But in the other corner, you have the opportunity, a historically low valuation, those world-class brands, and that sweet, sweet dividend.
So who is this for? Well, according to this analysis, it is definitely not a get-rich-quick stock. It seems to be a potential fit for a very specific kind of person. A patient investor, someone with a 3 to 5 year or even longer time horizon. It's for the dividend seeker who wants that steady income. And at its core, it's for the true value investor, the kind of person who loves buying great companies when they're on sale.
And you know, maybe the best way to wrap all this up is with this one powerful quote from the source material. The whole argument is that right now, you have a rare chance to buy a global leader at the price of a mediocre company. So the final question, really, is for you. Do you think they're right?